Hello and welcome to Moneycontrol. You've tuned into IPO Watch and I'm your host Nickey Mirchandani. Today we are going to be talking about facilities management services company, Krystal Integrated Services, which has come up with an offering of 300 crore. The IPO opens for bidding on March 14th. The public offer comprises of 175 crore and it's also divided into OFS of 125 crore. Now, Krystal Integrated Service price band is set anywhere in the range of 680 to 715 per share. But to know more about the company's financials, the USP and the business model, we're being joined by Sanjay Dighe, who's the CEO, and Barun Dey, who's the CFO of the company. Well, afternoon there, gentlemen. Let's start off with more about your company. Your USP versus some of its peers like Quest Corp, SIS, Update, B2B model, precisely if I'm not wrong, with a wide portfolio of services delivering a range of solutions. Yeah. How different are you from the other listed entities? That's one. What is the specific client that you cater to and why this IPO?
Oh, sure. I will start by the middle question one. The difference between us and the listed entities is we take a lot of pride in saying that we've grown organically all over the time. In the 24 years that we've spent time in this space, we completely believe on the talent that we have within, and our plan is very simple: to build our talent and to grow in the market. So the major difference is that we've not done any acquisitions; we've just grown on our own talent. The second key difference, along with our peer group, is the service offerings that we have for our customers is one of the widest services, and we are not restricted to a certain type of services. So whether it is integrated facility management service, security man guarding, housekeeping, janitorial, facade cleaning, pest control, building maintenance, MEP, everything. So we have the entire range, and that actually sets it apart. And it is not only me who is saying, but the FNS industry report also, it very clearly comes out here. Amongst the entire peer group, listed or unlisted, we are also the company which has grown fastest in the last 2 decades. We are growing at a CAGR of 21-22%, and also we are only the ones who have the best margins in that company. So it is a manpower centric company. It is a combination of man, machine, material, which is the IFMS, Integrated Facility Management. And our focus is on government and the corporate sector as well. Our exposure in the government sector for over 2 decades gives us a good pre-qualification criteria, and also our expertise in delivering services. We are one of the key players when it comes to larger government contracts. At the same time, on the corporate side, which is also our focus area, we are very happy to say that we have a set of loyal customers who are with us for the last 2 decades. Okay. Whether it is HDFC Bank with us for over 15 years, PD Hinduja Hospital with us for over a decade. So we enjoy loyalty for the simple reason our entire business structure is very, very simple. We still believe in customer is the king, and we always work towards making life for a customer a convenient life. So at the end of the day, that is what they are looking forward to. So these are a couple of things which sets us apart in this sector.
Well, point well taken there. Let's talk about the growth aspect first, which you've clocked in. You said 21 to 22%.
Sure.
Have I got that right? Over the last 2 decades, that's the CAGR that the company has grown as perhaps the fastest within the industry. Help us understand. You've outperformed the industry, right?
Yes.
So going forward in the next 3 years, industry is expected to grow at what rate?
The IFMS sector in the government is supposed to grow at 16.5%, and the IFMS sector in the corporate is supposed to grow by 10.2%. So there's a huge growth in both the sides which is happening. Predominantly in the corporate sides, because of the Make in India initiative, you see a lot of thrust on the manufacturing.
Right.
Once manufacturing is growing, then there's a whole lot of activities which come along with it, and the biggest one is the supply chain. So you have warehouses, you have fast track railways. The expansion of railway means new railway stations, expansion of the existing railway stations. Also the government is very, very focused on giving a railway passenger a similar example as an airline passenger. Somewhere I think they have a plan there. Now when that is the entire theme, so who's going to manage these railways? So they need companies like us who have the competency of integrating various services and then offering it at the right price point and a fantastic service delivery efficiency. So there's a huge way to go for decades, though we are talking about the next immediate future. But I think this industry has a good run for decades, which is what I believe.
So 21-22% what you've clocked in the previous decades, it is replicable, or you think you can outperform that?
Absolutely replicable. I don't know if it is the right way to say anything, a forward-looking statement. But yes, we are very confident that we will grow in similar way.
Okay, all right. Let's also talk about your EBITDA margin, which you highlighted right at the word go, that it's been the highest within the industry, and rightfully so. 7.7% is what the company has clocked in versus 3 to 4% seen by Quest Corp, SIS, Updater Services. Help us understand what helps you clock that margin, and do you expect the outperformance to continue going forward?
We definitely expect to outperform because we have a plan, we have a pipeline. Ours is a continuous business acquisition process, whether it is in corporate or in the government. Also, the mix plays a very important role for us. It is 70-30, as I told you. 70% comes from government and 30% from corporate. Again, it is a smart way of looking at things. We are very, very specific on what businesses that we acquire, at least in the government space. We are focused at healthcare, sanitization and education. These are the areas which are very important for any government because we have a pan-India clientele even in government. So these are the key sectors which have good budgets from the government. We also have experience now over 2 decades in servicing this. And over the period of time, after 2 decades spending with a particular kind of focus, you acquire ability to research a government tender, you acquire the ability to service a government tender. You generally are very smart in structuring your entire price points. So that there is nothing great or miraculous that we do to get this EBITDA margin, but these are a series of small things that we do which results in outperforming this market.
So your promoter is an MLA, and I believe it's BJP's ex-state vice president of Maharashtra. So by virtue of that, government orders coming in is something that we want to understand more about. How is the payments coming in from the government orders? Because though you have an edge when it comes to the margin profile, that edge is not seen on the profitable profile, because 38.44 crore compares with 200-300 crore compared to Quest Corp and SIS. So help us understand that despite clocking in that sharp growth in EBITDA margin, why is it not translating into bottom line?
Our PAT margins are although healthy. So I will answer your questions in 2 phases. We are a professionally managed company.
Right.
We've been running with an excellent professional team which comes from all walks of life, whether it is all MNCs, and it has taken us almost 1.5 decades to put in a fantastic team, because it was there is a vision that the promoter has, and to fulfill that vision you need a professional team.
Right.
And otherwise we wouldn't have come here and I wouldn't be sitting here in front of you.
I'm sure. And also the fastest growing, not taking that away from you in any way.
Yes.
I'm just saying there is a difference in terms of the bottom line performance as compared to the peers.
I will tell you why. We've seen also the government kind of business evolve along with the corporate side. The way it is evolved in a couple of things. One is the transparency that the entire mechanism has. Everything is online. If you fit in the pre-qualification criteria, if you are able to get your BG margin payments and all that done, you can upload a government tender from any point in the country for any state. We are a player which is a pan-India. We have a pan-India geography that we play. We work with the governments of Madhya Pradesh, Tamil Nadu, Haryana, Delhi, Maharashtra. And Maharashtra is not even the top one. Our top business in government happens in Tamil Nadu, then in Maharashtra, then in MP, then in Delhi, then in Haryana.
Right.
So and having said that, it is not only the entire bidding process, it is also we've seen a sea change in the payment process, because that was your very critical question.
Yes.
And you will be happy to note that our government receivable cycle is 60 to 90 days. Our corporate receivable cycle is 45 to 60 days.
Okay.
So, if you see in number of days, there is not much of a gap.
But there is some gap, irrespective, and that is 70% of your revenue.
And that is going to remain that way, because the nature of business is larger. The service tenures are larger. In government, you have a 3+1 year tenure. In a corporate, you have 1 year renewables. Again, the government tenders structurally are large. Therefore, you have to give that number of days to them, because it is important for them to manage that. The entire process takes long. So, for example, we are managing say 125 hospitals in a district place of a large state. To assimilate that data, to make evaluations, to approve those things, to go it through audit, that is the time durations that they take, and which is very practical in that way. Unlike a corporate where system is a little more standalone.
Okay.
So therefore everything is quicker there.
Right.
So therefore 45 to 60 days here and 60 to 90 days there. Overall, if you see, even in RHP that we have said, it averages to 77 days.
Okay, the reason why I also asked you this question is because maximum amount of your fundraising is going towards working capital requirements. That's one. And does it got to do with the fact that it's also because 70% is going towards government contracts, and by virtue of that you would probably have a little more when it comes to the working capital requirement needs? Help us understand that.
Oh, a very, very good question, but actually not that way, because we are acquiring at one side government business, but we are also very, very fast ramping up our corporate business side, especially in this Make in India. We've already opened 2 offices in our industrial corridor. Industrial corridor is a new vertical that we've opened, because, and you would know better, all these SEZs are far away from the city, almost 60-70 kilometers away. And if we want to be if we want to make that our playing field, we need to be present there. So
Right.
there is certain expense which is happening in that expansion. Also, when we are acquiring brand new customers in the manufacturing units, either a manufacturing unit is being put up new, or the existing one expanding, or some JV is coming. We are still trying to assess where that credit period is going to be 45 or 60, or that cycle is a little longer than that. So putting together is what is the need of this 100 crore. It is not going to be lopsided in one particular sector. It is going to be balance out the corporate and government as well.
Sorry, I missed out. Where does this 100 crore number come in?
For our, it is all going to go to our wages. It is all working capital.
All right.
So the breakup of our,
correct.
The
Yes.
breakup of our 175 is also very simple in
Correct.
the objects. 100 will go to our working capital.
Yes.
And 10 crore out of that.
For a new capex plan that you have.
New
that's-
capex
yes.
plan for machinery, because we are bundled services of man machine material.
Point well taken.
So 10 is going to go there. 10 is going to go towards retiring a very small term loan.
Yeah.
That is there, and that is there, and 55 crores is a GCP, general corporate purpose.
Yeah, I got that. But the limited point that I'm trying to make is, going forward, how do you intend to further fund your working capital requirements? Do you see that as a concern? Talk more about your debt, talk more about the balance sheet strength.
We have a good balance sheet. This IPO money that we are going to raise now, as per the cash flow calculations that we did while submitting our DRHP at that time, this is going to help us go through at least 3 years of business.
Okay.
Business cycle.
Okay, so take care of your 3 years of business
because
requirements.
this is not going to last us for longer than that.
Correct.
And that is how the cash flow is structured in a
Okay.
way. And as I said, that sales and business acquisition is a continuous process.
Yeah.
So I'm sure we will see the way how 3 years are going to perform, and then we will again plan out.
So where is the incremental growth going to be coming in from? The reason why I ask you this question, and the little that I gather, A, you're a company which focuses on organic growth plans.
Yes.
Correct?
Yes.
B, you are also a company who has been growing fastest in the industry.
Yes.
3 years of working capital requirements, so your business cash flow needs have been taken care of.
Yes.
Post that, what? How do you intend to scale up?
Again, 2-3 things. We have customers who are standalone customers. We have customers who are pan India customers. The growth is coming from 2-3 areas. One is when the customer grows, and the opportunity that the customer gives us. For example, we are servicing a manufacturing unit, and we've been doing that for over a decade. They have now warehouses coming in. They had 8 brand new warehouses. We got all of them. So brand new business, but from the same customer.
Okay.
Number one. Second is brand new customer acquisition. The way our sales process goes in corporate, we have a retail sales. So anywhere between 10 to 50 lakhs is our retail per month billing. So there is a team which is focusing on that. These are business which are easy to close. It is like meter down. Every week business is closing. Then there is 50 to a crore, which is key accounts. So takes a little more time, but robust businesses and good kind of customers. And then 1 crore and above, which is major accounts. So the sales team is structured as any good sales organization. You would find this happening in typically a sales driven organization. So we have distinct team which focus on this area, and just imagine cascading it to 21 branches that we have. So this activity is happening daily right now as we speak on a national basis. You can imagine the pipeline that this churns on a weekly basis. We have a data management of that. We have a closing cycles. We also have life cycle of a corporate sales. Assume I get this account today. I mean, we sign an agreement, and the expiry is 13 March 2025. We have already mapped that, and we know in case it's renew, it's an add-on. In case it doesn't, then we have a huge number to compensate.
So what is the outstanding contracts now sitting at, or the order inflows that we are sitting at?
They are very high, but I think there are good government tenders which we are expecting results. March is typically our year of closing and renewals.
So that's exactly why I'm asking you this question, because it's pertinent for the next financial year.
There are some key discussions which are already happening. Proposals have been already submitted. We are just waiting for LOI, work orders, or if we have the LOI, then agreement process is on. The idea is to close all, obviously.
Any number that you'd want to put in?
I don't know if a forward-thinking statement can be done or no. That is a big thing which actually makes me stop in my steps.
So just to sum this up, the company plans to offer in more value-added services to the existing. And add more new customers. That's your growth profile or the growth strategy going forward.
Very right.
In terms of the strategy, Maharashtra, Tamil Nadu, these are few states that you mainly operate in. Do you intend to diversify the geography or your offerings for that matter too?
Yeah, sure. Today, Tamil Nadu, Maharashtra, MP, Delhi.
MP
Delhi. And obviously we have plans to get into UP. You can't miss out that, especially now with the temple tourism also happening.
That's exactly.
And that is one of the sectors that we are aspiring to grow. We already have our plans there with these new corridors which are coming. Because now it is not only about temple, because the visitors in the temple, all now kids, the younger generation, all the youth, they want to go there for various reasons, the architectural,
spiritual tourism,
everything. So it is, temple is one thing, but everything that is going to happen around it is also very big. We are very serious about it. Again, the way the airports are developing, the new airports are being announced. We have almost 1.5 decade of experience in servicing our Mumbai airport, Mial. When they got privatized in 2005, we were the first players there when the RFP was floated. So we have a huge experience in the airport in multiple services. So one interesting thing that you can, and you would know that when I start saying, whether it is railway or airport, your service, multiple services can be sold there. So you can sell services individually, and you have the opportunity of bundling them also. So it's a brilliant stage that is set with this infra development.
I am now curious to ask you, this 7.5% can go into double digits anytime soon, given the kind of opportunities that you mentioned, and we've seen that exponential growth which is coming through. How far are we in clocking that double digit growth?
Tempted to answer, but I will have to balance this answer in a little diplomatic manner. We will continue to grow the way we are. At the same time, we are seeing our margin profile is going to be definitely better. And so I'm not supposed to make these statements, but there is also
you can always give a direction in terms of the double digit growth. I'm not asking you to put a number to it. I'm just saying in terms of double digit growth, you think it's doable by FY25 hypothetically?
We are looking forward to that. We have plans to do that. And there is enough scope. There is enough geography, because you touched upon geography also. So there is enough geography, and I didn't answer that. Yes, we are trying to expand our geography also up north. We have a good presence everywhere else. So UP, up north, east, that is definitely on our radar to add those branches. But there is also a methodology to which we grow. We don't go set up a shop and then hunt for business. We try to acquire a business in a good way in a particular geography, and we set up that shop. So there is enough potential to look forward to a good margin profile.
So would you also be open to inorganic expansions?
At the moment, to be very honest, we don't have any plan, because we've grown organically. Not that it is a certain mindset, but the idea is to keep the business model very simple, to keep the processes very simple, so that it is convenient for the customer, because at the end of the day we are hired to make life convenient for them. So as simple we are in our approach to a customer, and it would come by doing our business.
Okay.
So simplicity is what really matters to us. And at the moment we have not even planned anything further. We just want to build on what we have learned. We want to learn again, build on what we have learned, and that is what.
Okay, all right, got your point. Barun, I'm going to come to you. You've something, you've been on your own for a while, but let's talk about the government sector. It's grown at CAGR of 10.4%.
Yes.
From FY 2018 to 2023, higher than 6% growth recorded by the private sector during the same period.
Yes.
The revenue from government orders, that's the point that we've been discussing right from the start of this conversation, is grown to 69.4%, let's just say 70% in FY 21 to 76.3% in FY 23.
Yes.
You see that pie more growing further, because now as you explore in the northern territories, UP, up north, do you expect that share of pie to increase further?
The thing is that you have rightly pointed out that initially till March 23, our footfall government pie is 70%, which has scaled up to 76%, 74%. Now, why that has happened, that also going to explain, because in the first 6 months in that current financial year, we have 2 big government contracts. So for that only, that percentage has shoot up marginally. But overall, I think in our roadmap and our our portion will be 70-30 ratio only.
Okay.
Yes,
right.
Because what are the pipeline, what are the focus we have. So
which of the 2 businesses is more margin accretive? Is it customer or is it government? I'm assuming government business should be.
Government is, yes, you are rightly pointed out, government is much higher than corporate.
What's the difference?
Say difference you can see more near about 14 to 16 in case of government, and it is 8 to 9% in that corporate.
Oh, so that's a huge difference that we're looking at. That why not increase the share further to government in that case?
See, that depends. We want to create our footfall in both the sectors. So that is our intention. So going forward, because we are very choosy about selecting the projects. Not that what are the project that is line up, we will going to catch it. If it is a profitable, sustainable business, then we will focus. Not like whatever the government contract that is coming, we are blindly accept that one. So we need to internally analyze it. If it is bottom line wise, it is fruitful to us, it will add to my peer. So we will definitely take up this in that way.
How do you intend to then improve your bottom line here on? Because that's also something that I think I've spoken to the CEO also, and I think that's an area of concern, right? Because margins growing this fast and the bottom line not keeping up the pace is something, at the end of the day, from a very shareholder perspective and not just the functioning of the business, bottom line is what you're going to look at, right?
See, if you compare with our peer group, as far as PAT is concerned, so the main reason is that we are grown organically.
Right.
In that case, in other peer group, their growth is part of organic as well as acquisition also.
Right.
So that acquisition will boost your profit.
Correct.
So bottom line also. In our case, 100% we have grown organically, and that is our, if you see our PAT curve, it is normal.
That also goes on to signify the risk-taking capacity. Help me understand this business model and correct me here.
Yeah, you ask.
I mean, a 0.3% of debt to equity ratio is the lowest that we have in the industry.
Yes.
Quest Corp, SIS, Updater Services, all of them have a significant, fairly decent debt to equity ratio, if I may say.
Yeah.
1.24 for Quest Corp. You have 1.45 coming in from SIS, and probably Updater Services is also in line, but more, 0.46. So at going forward at any given point of time, is there a number that you guys have set internally that we are not comfortable with the debt coming in on the books and debt to equity needs to be this particular level, and hence organic growth is what we are going to stick to?
Yes.
Is that a conscious strategy?
Yes, you
If you see-
you are.
Sorry,
Can I
no.
answer that? Actually, that we are very we are very focused on our receivables. We track it actually on a day-to-day basis. So our entire focus is to ensure we collect the money on time. We will go ahead and try and collect it faster. So even if we are saying technically the recovery or receivable cycle, we have a CCRM team, credit control and risk management. So that is one area that we absolutely aspire, and we track our working capital utilization on a week basis. Idea is to not be very debt heavy company. And I'm going to come back and revisit your margin question, because it's the second time you touched on it. As he rightly said, the government has better margins, but the way that I explained you the growth that is happening in the corporate sector as well, the current corporate sector, the customers that we have, the very traditional customers, the growth that you are saying, because in the next 5 years is going to happen in sectors which are going to require a different skill set. It is going to require a different kind of manpower.
Which sectors are we talking about?
Predominantly, even if I spoke about the manufacturing sector. Now, for example, a standalone building like this, the manpower I will require to have upkeep of this, and say a plant, manufacturing plant, you are going to require some really different services there.
Correct.
Also, the profile of people that you are going to engage are very, very different.
Correct.
And therefore, the sectors which are upcoming now, even the corporate sector has the ability to give you better margin.
Okay.
So it is not only that we are depending on
No,
that
the reason why I
margin.
was asking this question is hospitals has come down from the revenue contribution from 34 to 30%. Education has come down from 30.7 to 20.22% in the first half of the financial year. We have seen a significant growth coming in from public administration, and similar is the case also with a few other financial services. But any other particular sector per se that you're focusing on where you expect the revenue share to grow in? And the second part of the question is, from the sectors that you cater to, which one is the most margin accretive?
Okay, the sector that we expect to grow in is solid waste management.
Okay.
We are also doing that. That is
Okay.
one sector that is expected to grow. It will also add to our contribution. It is also a sector where there is an opportunity to
Okay.
have good numbers.
Fair enough. Fair
Number
enough.
one. In terms of sectoral combination of better numbers, IFMS, our business is IFMS staffing, security, man guarding. IFMS has a better margin profile, and also in terms of the healthcare, education and sanitization, the education has a better margin profile.
Okay.
So if these are the two questions that.
Sure, that's all that I have in that case, and thank you so much for taking out the time and having this conversation here with us. That was the management of the company, pretty much confident when it comes to the tailwind in the industry. Expected to grow at a pace of what they have been growing, 21 to 22%. They've been tapping into new geographies. Up north is where they will probably step their services up from. And of course, margin profile of the company is better than peers, but profit is something that they'd be ramping up by adding in more customers and also adding in value-added services to the existing customers. But with this, it's a wrap. Thank you so much for tuning in.